Damos la bienvenida al orador principal de esta mañana, el señor Tobias Adrian, consejero financiero y director del Departamento de Mercados Monetarios y de Capital del Fondo Monetario Internacional, área a cargo de la publicación del reciente informe sobre estabilidad financiera global. El señor Adrian lidera el trabajo del FMI sobre supervisión del sector financiero, políticas monetarias y macroprudenciales, regulación financiera, resolución bancaria, gestión de la deuda y mercados de capitales. También supervisa las actividades de creación de capacidad en los países miembros del Fondo Monetario con respecto a la supervisión y regulación de los sistemas financieros, la resolución bancaria, la banca central y los regímenes monetarios y cambiarios y la gestión de la deuda. Antes de unirse al Fondo Monetario, el señor Adrian fue vicepresidente senior del Banco de la Reserva Federal de Nueva York y director adjunto del Grupo de Investigación y Estadísticas. Ha publicado numerosos artículos en importantes revistas de economía y finanzas y cuenta con un PhD del Instituto de Tecnología en Economía de Massachusetts. Bienvenido, Dr. Adrian. El podio es suyo.
Morning. Good morning. I'm very honored to be part of this conference, and I'm very happy to share with you this morning our global financial stability assessment. So that's the IMF's assessment of markets and global financial stability at the moment. So let me share my screen now so that you can follow my presentation. So you should be able to see my screen. And so let me start by setting the backdrop by looking at total output. So this is global output divided up into three parts: advanced economies, emerging markets, and low-income countries or developing economies. The green shows you the pre-pandemic projection. So we start the chart in 2019 and it goes through 2025. And the red is the projection as of October 2021, so as of now. So what you can see is that advanced economies are expected to hit their pre-pandemic trend output by next year. And in fact, by 2023, output in advanced economies might be above what we had expected back in 2019. The picture is different for emerging markets, where we do expect a recovery, but we don't expect that emerging markets as a whole will catch up to the trend output that we had projected pre-crisis. And the gap is rather large. It's about 10% in terms of levels. And then when you go to low-income countries, the gap is even larger. So what the chart is showing is that the crisis hit relatively poorer countries more adversely, and the recovery is much quicker. The higher output is. So the richer the countries are. So basically, the crisis has made the world more unequal. Now let's take a look at our uncertainty, at the uncertainty around this global growth forecast. So 2 years ago, for 2020, we forecasted, very negative growth, about -5%. And there was a substantial downside risk around that. We have come a very long way from that. At the moment, the global growth forecast is closer to +5%. So from -5% in 2020, we went to +5% for 2022. So that's the forecast as of now for 2022. And what you can see is that there remains quite a bit of downside risk. So the red chart, the red density is the current forecast, and there's a lot of downside risk. So we might, with a 5% likelihood, we might end up with zero growth next year. There's still a lot of pandemic risk. There's a lot of financial stability risk. I'm comparing this here to the historical density, which has much less downside risk. But still, in terms of the modal outcome, we're looking very good. So why is this outcome so dramatically better for the global economy today than 2 years ago? And in our assessment, good policy choices have a lot to do with that. So the left chart shows you the global financial conditions. So these are financial conditions, so financing conditions. And they are represented in indices. And we're breaking that down into 5 regions in the world: the United States, other advanced economies, and emerging markets outside of China, and then China. And so what you can see is that financial conditions are very easy by historical standards, in particular in the US and the Euro area. They're somewhat tight in China, but they're also fairly easy in emerging markets. And the reason that financial conditions are easy is that central banks expanded their balance sheets very, very dramatically. So the right chart shows you the size of the balance sheet expansion on the left chart. And this is as percent of GDP. So you can see that last year, at the height of the crisis, total balance sheets of the Federal Reserve, the ECB, the Bank of Japan, and the Bank of England were increased of a magnitude of 2,000% of GDP. And so within 18 months, the size of central bank balance sheets went from about 35% to 60% of GDP. So that is a massive increase. And that the intended consequence of all of this is to ease financial conditions, is to get interest rates down, to lower credit spreads, and to allow countries to issue debt. And so that has worked, in particular in advanced economies. So let me just go back to the first slide. So in advanced economies, you had a tremendous success here, some success in emerging markets, but less so in low-income countries. Now, one of the unintended consequences of the very sharp easing of monetary policy is, of course, that asset valuations are increasing dramatically. The left chart shows us estimates of asset price misalignments. Compared to January 2020, equity market misalignments are much, much larger by orders of magnitudes, according to our models. So asset valuations are stretched, and that presents a risk going forward. So in the short term, it's good because it allows companies to issue equity in markets. They can finance new expenditures, new capital expenditures. But of course, in the medium term, there's the risk of a sell-off in equity markets. The picture looks very similar when you look at the high-yield bond market. So high-yield bond spreads are at very low levels. That's the yellow line. The high-yield spread, you really have to go back to 2007 to see such a compressed spread. At the same time, default rates remain very low. And that's because there was not only expansionary monetary policy, there was also expansionary fiscal policy that played a key role in this crisis. And a lot of the fiscal support went to the support of borrowers. So we see default rates that are very low. Now, one of the big surprises, perhaps, of this crisis is the magnitude and the persistence of inflation. So the left-hand chart shows you inflation for the Euro area and the US, and the right-hand chart shows you inflation expectations for emerging markets. So starting with the left chart, these are break-even inflation. So these are market-implied inflation rates for the US, say. The 5-year, that's the thick red line, shows you that expected inflation over the next 5 years is dramatically higher today than it was pre-pandemic, right? It's at about 3% compared to 2% pre-pandemic. However, the medium-term inflation expectation, so that's the 5-year forward implied inflation, remains contained. It's at about 2%, which is around the target of the Federal Reserve. For the euro area, you also see a dramatic increase in expected inflation, but both the 0 to 5 year and the 5 year expectation is around target of 2%. So for the ECB, that's actually a very good outcome. So there isn't a sign of the anchoring of inflation expectations in the medium term in advanced economies now. Looking at emerging markets, when you look at inflation surveys, you also see that inflation is expected to be above target through 2022, but then to return back to target at about 2023. But that is, of course, an outcome of dramatic tightening in emerging markets, and we're going to see more about that in a moment. So, having said that, even though inflation expectations remain well anchored in the medium term, there's quite a lot of risk around inflation. And indeed, you can see that the inflows into inflation hedging instruments, so in the US, shown on the left chart, these are the inflation-protected government bonds. Those inflows have been at record highs. So investors, people that are saving for their retirements, are worried about inflation. And indeed, when you look at inflation swaptions, so these are options on inflation outcomes, you can see that particularly for the US and also for the UK to some extent, there's a very high likelihood that over the next couple of years, we're going to end up with inflation above target. Now, inflation has been so strong that this has led to a reassessment of markets in terms of liftoff. So the left chart shows you the shorter term expectations for the liftoff in the US, the Euro area, the UK, and Canada. And you can see that in particular for the UK and Canada, there has been a very sharp increase in the path implied by the markets in terms of forward rates, right? So for the UK at the moment, the interest rate is 0. It's expected to be 1% in the middle of next year. Similarly, in Canada, the interest rate right now is close to 0. It's expected to be above 1% by the middle of next year. The euro area is not yet expected to lift off, but the US is also expected to lift off with about a 50 basis point increase in the middle of next year. At the same time, you might have followed this week, the Federal Reserve announced the tapering of its asset purchases. The Bank of Canada had done that earlier, and some other central banks might follow suit. So we expect that asset purchases are going to taper tremendously, and that might have adverse consequences for global financial conditions. A particular idiosyncratic risk factor at the moment is the debt limit in the US. So the left chart shows you the cash balances of the US Treasury, which are approaching 0 very quickly. And so the US has to come up with some deal to increase the debt limit in order to be able to raise more money in markets. You can see that around the negotiation time, around the end of 2021, there's indeed a slight spike in the pricing of treasury bills, but it's not very extreme at the moment. So the market doesn't right now put a lot of weight into this distress, but that might change at some point and it might spill over into other markets. Now, let me return to what I said earlier. So inflation in emerging markets is expected to return to target levels, but that is taking into account that the policy rate in many emerging markets has been increased dramatically. Perhaps the most dramatic example is Brazil, where the interest rate was already raised by nearly 5%, and it's expected to be raised by another 5 percentage points going forward. But that is also a picture in many other Latin American countries and around the world in emerging markets. And so inflation is expected to come down, but that is subject to dramatic tightening of monetary policy. And of course, what we're worrying about here is that domestic interest rates on domestic debt, sovereign domestically denominated debt is going to increase dramatically. And that could put that sustainability at risk. So the right chart shows you, just for low-income countries as an illustration, that at risk, already 50% of countries are either in distress or close to distress. And emerging markets, we might see more emerging markets going into debt distress because of the much higher interest rates. Now, having said that, hard currency issuance has been extremely strong. And that is even for the riskiest borrowers in the world. So these are frontier markets. So these are low-income countries have been able to issue, and they have issued dramatically strongly over the past year. When you look at the broader emerging market universe on the right, you can see that emerging market hard currency issuance has been extremely strong. That's the black line. And China has been able to issue local currency debt, but other emerging markets have had a more difficult time to issue local currency debt. So you could issue hard currency debt, like dollar debt, but not so much domestic currency debt, except for China. And so that has led to a new concern in many emerging markets where a lot of this local currency debt has been bought up by banks. And so there might be a strengthening of the sovereign bank nexus that might have occurred. So if there was distress at the sovereign level, that would spill into the banking sector very quickly. Now, let me talk about China in particular. You've all read about Evergrande, a property developer in China. So the left chart shows you that the leverage in the non-financial corporate sector, which includes the property sector, is extremely high and has been rising dramatically. This year, Chinese authorities have started to crack down on this leverage, but that means that some of the developers are in distress. And for the moment, that hasn't led to contagion yet. So that's the right chart. You can see that bond spreads haven't widened, even though the property development sector is in distress. But note that the property development sector is quite large in China. It's about 20% of investments. One of the biggest risks at the moment is the tremendous valuation in crypto assets. The left chart shows you the total value of crypto assets, including Bitcoin, Ethereum, other smart contracts, and stablecoins. And you can see that the market valuation is close to $2.5 trillion globally. So that is extremely large. And it's starting to approach something that is globally systemic. In many countries, these Bitcoin transactions and Bitcoin investments are already macro critical for the country. And you can see that the volatility of prices is extremely high. So we worry that investors are not aware of the tremendous risk that they are taking. In fact, the right chart shows you the open interest in futures on Bitcoin and Ethereum. And you can see that the price swings, the up and down of the valuations of Bitcoin and Ethereum go hand in hand with derivatives positions that are scaled up and down. So there are levered investors in this market already that are trading long positions and short positions depending on how the market evolves. And it's not clear to us that individual investors in the space are aware of these kind of levered traders that are in the marketplace. Now, one particular focus of our concern are stablecoins. So the largest stablecoin is called Tether, which is invested in commercial paper, corporate bonds, and cash. But of course, it promises stable value, but it can't actually guarantee stable value because the asset side of the balance sheet is in risky assets. You can see that there are some stable coins like the Binance US dollar coin, which is entirely in cash, and that should be very close to stable. But there are others even like DAI, which are extremely risky, which are invested in Ethereum and other crypto assets. And so we worry that there's run risk in the stablecoin market, very similar to money market funds where we have seen runs. In fact, this year in June, there was already a bank run on one of these stablecoins. That's shown on the right chart. So investors rushed in to sell, and the valuation imploded, and investors didn't get their money back. Now, looking at the banking sector, we are running a global bank stress test, and the left chart shows you the global outcome and the advanced economy outcome, which is a very good one. It's a 3% loss in a very adverse scenario. However, for emerging markets, the losses are nearly double. And this is just the aggregate for emerging markets. There's some emerging markets where losses in the stress test are much larger. So we do worry about that. We also worry about international claims. These are international bank claims to emerging markets. About 40% of international bank claims come from other emerging markets. And those claims are extremely volatile, right? So borrowing by emerging markets from other emerging markets in terms of bank loans is a very risky proposition, but it's very large in magnitude. Finally, let me turn to green investment. So as the world struggles to shift into greener sources of energy and greening the economy more generally, financing for this green transition is extremely important. The left chart shows you total assets under management by investment funds. So globally, we have about $50 trillion of investment in investment funds, but only a very small share of that is in sustainable funds. That's about $2.5 trillion. And only about $300 billion are in climate funds. So this is a growing category, but it is still extremely, extremely small relative to the broad universe of investment funds. Having said that, the sensitivity of flows to fund labels is extremely strong for climate funds. So if you have a fund that is a climate fund, there is extremely strong inflow into these investment funds when general inflows are happening into investment funds. So put differently, there's a lot of investor appetite into climate investments. We can also see one of the channels of how investing into green funds is improving the economy. So the left chart shows you votes supporting climate resolutions by conventional funds versus environmental funds. You can see even for conventional funds between 2015 and 2020, there has been a sharp increase in positive votes in order to support climate action. But the magnitude of those votes is much higher in environmental funds. Finally, the right chart shows you that inflows into sustainable funds help firms that are more sustainable relatively more in terms of raising capital. So that concludes my presentation, and I'm going to stop sharing my screen, and I'm happy to take some questions.
Apparently, we do not have questions from the audience yet. That said, we thank you for your words.
Thank you so much. I'm very happy to have been here. Thank you so much for having me. Bye-bye.
We are most grateful that you took the time to join us today. Thank you very much.